Hey guys, welcome to the final part of my options day trading course. If you're new here, I'm Tex and I share my journey with trading and investing in the stock market. So in the first part of the course, we did an introduction to day trading and just talked about the requirements and everything that you need to get started. In the second part of the course, I reviewed my broker and chart settings and platform and indicators and everything that I like to use for day trading. Now in the third part of the course, we got into the psychological aspect of trading and discovered why it's the most important factor to your success. In the fourth part, we started learning technical analysis and how we can use that to effectively day trade the stock market. In the fifth part, we took those skills that we learned and applied them in a support and resistance workshop. In the sixth part, we started learning about options, what they are, how they're priced, how we can pick strikes and expirations, as well as how we can manage our risk when day trading options. Now in the seventh part, we did a price action workshop, which included a practical example and live video of level 2, time and sales, and the chart itself and seeing the price action play out in real time. Now in this part of the course, we're going to start covering my strategies and trade criteria that I actually use for day trading options. Now in case you missed any parts of the course, I put a card at the top of the video. Go ahead and click on that. It's going to take you to a playlist where you can go ahead and watch any part of the course. Also, as a reminder, there's a bunch of helpful links in the description box below, including one to a glossary of terms. So if you hear something you don't know, go ahead and check that out and you can read all about it. If you would guys, do me a favor, please hit that like and subscribe button. Show your support for the channel. I really do appreciate it. So with that said, let's go ahead and get started with the video. Now, while there's a lot of day trading strategies, I really have three that I focus on for day trading options. My favorite is an opening range scalp because I love to capitalize from the higher volatility right after the market opens. It's basically my way of trading a potential opening range breakout. However, this strategy involves buying a dip into support, usually in the first 5 to 10 minutes. Now, of course, guys, this is with bullish context in play on the macro timeframes. In other words, the daily time frame has been trending higher and looks good for a continuation of the trend. Otherwise, with bearish context, I'd be looking to short or rather buy puts into resistance. For this setup, I like to see price sell off from the open into a level of support. This is important, guys. The first move has to be lower into a support level. My favorite levels to use are the prior day's high, low, or close, the pre-market high or low, and also levels from the pivot point indicator. As price approaches my entry point, I begin scaling into my position. Watching the tape and price action at my entry point is very important. I'm looking for a clear signal that buyers are stepping in as price interacts with a technical level. If I'm waiting for confirmation that I want to see a higher low or signs of price basing over the support level. What I mean by basing in this context is multiple candles with long lower wicks that keep closing over support. This is telling me that buyers are defending the level. I usually look to target the VWAP or the opening price where I'll take most of the position off. If I have a lot of conviction on the direction for the day, then I'll leave a small piece on for a potential opening range breakout. Now we're all different, but personally I'm more comfortable buying options on dips versus breakouts because the premiums will generally be inflated with the extrinsic value by the time the breakout triggers. So if it fails, guess what? Those option premiums can fall apart real quick. Now I'm not saying you can't make money trading breakouts with options, but it's just not usually for me. Another scalping strategy I use is more of a counter trend play when a stock is trading at extremes. I call this a contrarian scalp. This is when a stock gets extended, creating an imbalance in price as it's coming into a key technical level. I'm basically scalping a pullback or a short-term reversal as the chart on the left demonstrates. One of the reasons I love this strategy is because it offers a lot of opportunities to profit regardless of the larger trend. I'm basically taking advantage of the premiums getting crushed by volatility as the stock goes parabolic into a technical level. Now, timing the entry at the technical level makes it easy to get a quick return as the premium rebounds with the stock. However, guys, this is not a strategy I use on just any stock. For example, I would never do this on a penny stock. you have to realize the stocks I'm day trading options on are some of the most bullish stocks in the market. Now, as long as that bullish context is intact, then I'm comfortable taking trades like this. But it's not for everyone, so this is something you'll have to figure out as you learn what kind of style you're most comfortable trading. In order to improve the odds, I use a specific list of criteria that we'll review in just a minute. The third strategy is a flag breakout. This is when a stock breaks above a descending trend line after a period of consolidation. You can reverse the idea for short setups by looking for a break below an ascending trend line. The longer price traded in a tight range before the breakout triggered, generally the larger the move will be. Additionally, this setup will be more powerful on longer time frames, but it can be traded effectively on intraday time frames as well. For a bullish flag breakout on an intraday time frame, it's very important that the stock is above VWAP. The trigger is a break above the trend line on increasing volume. The stop on this setup is triggered if price falls back below the trend line after attempting to break out. Now, sometimes these flags take some time to develop, so you may find that numerous adjustments have to be made to the trend line before the real breakout occurs. Volume is the most important factor when the breakout has triggered. You must see volume increasing, indicating more buyers are stepping in for the trend to continue. This momentum has to be present. If it's not, then the breakout is most likely going to fail. No matter what strategy you trade, there needs to be appropriate entry criteria in order to trigger a trade. These criteria help define your edge, which is part of your process and sets you apart from other traders. Trade criteria can be based on technical levels, price action, volume trends, or price patterns, for example. The criteria you establish creates the foundation of your trading system and offers a systematic approach to achieving consistency. The most important thing you should be focusing on is consistency, even if you're losing money. If your methods are consistent, then you can better analyze your trading and experiment with changing one thing at a time until you're profitable. Now, throughout your process, always ask yourself, what is my edge? Is it spotting setups, timing entries, maybe managing trades, or reading price action? You should constantly evaluate your process and your daily behaviors as your trading evolves. So I use 5 criteria for scalping options. The first is that price must be at a key technical level where an inflection point is most probable. Only execute at technical levels, never in the middle of a range. Now, listed in order of importance, the levels that offer an entry point include swing highs or lows from a daily time frame, prior day's high or low, pre-market high or low, levels from the pivot point indicator, or moving averages on the daily, especially the 5 and 9 EMAs. The second criteria required is measured potential. In other words, there needs to be clear potential for price to move without significant resistance. So you can't be taking a trade off a support level if it doesn't have much room to run until it finds resistance again. This is particularly true when trading a contrarian scalp. In this example, Tesla sold off with speed and distance into the prior day's high. You can see a visible extension from the 1-minute 9 EMA on the left side and the 5-minute 9 EMA on the right side. This extension with multiple time frames into a key technical level is ideal. The third criteria is a defined plan for how and when you'll enter the trade, cut it for a loss, or take profits. For example, you should not only know in advance the technical level where you'll be entering the trade, but also how far you'll risk from that level and the max number of contracts you'll buy. Carefully consider the cost of the contracts, the delta, and the time remaining until expiration as we discussed in the risk management section. Your plan should also include a max loss. This is the point at which you must cut the trade off regardless of your technical stop. Now finally, you should have targets where you'll take profit. My favorite targets include levels from the daily time frame, pivot point levels, the 5-minute 9 EMA, VWAP, or moving averages on the daily time frame. Ideally, you should be aiming for at least 2R on the trade, but sometimes you may only realize 1R when contrarian scalping. Flag breakouts and opening range breakouts with macro context will generally offer the best reward potential. Now, this example demonstrates how you can formulate a trade plan during pre-market. On this day, Apple was gapping over the prior day's high, so the plan was to look for a dip off the open to buy calls into the previous day's high, anticipating an opening range breakout. A pivot point level just below provided a risk area, while the pre-market high and another pivot point level above provided good targets. The chart on the right shows how the plan was executed. Note how price didn't quite reach the entry level. Sometimes this happens, and this is the reason I start in as it's coming into the level rather than waiting for it to hit it precisely, but only if I have strong conviction in my trade thesis given the macro context. The fourth criteria is price action confirming my entry point. For example, a contrarian scalp needs volume capitulation to signal a reversal point at your technical level. This is when market participants exhaust the trend, resulting in a rebalancing of the stock. You're looking for extreme volume to peak as price comes into the technical level you're planning to enter. Sometimes momentum will cause price to overshoot the level, so don't be alarmed by this common behavior. This should be followed by a visible decrease in volume observed on the time and sales and the volume bars on the bottom of the chart. Additionally, for any breakout trades, you must see clear momentum via increasing volume observed on the tape. In other words, when the breakout level triggers, you should see a clear increase in momentum on the tape scrolling very, very fast, and you should also see the volume bars on the bottom of the chart starting to trend higher. Reversal patterns are another form of price action confirmation. These are distinguishable patterns that we reviewed in the technical analysis section of the course and may include things like a double bottom, a double top, or maybe a higher low or a lower high. Reversal candles, like a hammer candle at the bottom of a selling trend or an inverted hammer at the top of a buying trend, can also be used as price action confirmation. These signals are going to be more powerful on longer time frames like the 5-minute, the 15-minute, or the hourly. The fifth criteria is that the market internals support the trade. This just means that you're not trying to buy a dip on a day when the entire market is selling off on high volatility and the breadth is showing an incredibly bearish number like -3 to 1 or greater. Also, you shouldn't be shorting a stock ripping higher on a positive catalyst. A news-driven move will often completely ignore technical levels given the highly emotional force driving the move. In addition to establishing criteria for entering trades, you also need to have some criteria for exiting. Now, of course, your trade plan dictates your stop loss and your profit targets where you intend to exit, but those targets won't always get hit. Sometimes the market will give you an exit signal before that, so I've established the following criteria. Number 1, if the stock pulls back and then fails to put in a new high or low, then I will exit before my planned target. For example, if you're holding calls and the stock pulls back from the initial high of the day and then fails to put in a new high after the pullback, then it may indicate the trend has been exhausted. Now, when trading options, you'll give back a lot of profit if you miss this nuance in price action. And while it's not perfect, you could use the 9 EMA on your 5-minute time frame to gauge this. Ideally, if the trend is strong, you should not see a 5-minute candle close below the 9 EMA. The chart on the left perfectly demonstrates this concept. Number 2, if the stock moves sideways for too long. Remember, you're fighting time with options, so you want to avoid extended periods of consolidation in which the premiums steadily lose value. On days when the price action is choppy, you will often see an indication of this as price trades through the VWAP with little to no respect for it. And number 3, if there's some news or Fed rate decision expected before my trade reaches the planned target, then I will exit the position in order to avoid sudden volatility. These news events can lead to knee-jerk reactions rippling across all of the stocks in the market, so it's safer to close everything before it's released. Now that we've looked at an overview of my strategies and trade criteria, let's take a look at some practical examples with some live videos. Alright guys, so in this example, I want to show you what I call an opening range scalp, followed by a proper opening range breakout. Now this was on Apple the last week of last year. There was a positive catalyst that had come out, so it was gapping up higher from the previous day. Before we jump into the daily chart and look at that macro context, just very quickly point out the very clear opening range that you have here, and then you have that breakout from that range. So that's your classic opening range breakout. The way that I would trade this with options though is a little bit different versus waiting for the breakout to trigger. As I said, the options will gain a lot of extrinsic value by the time a breakout triggers. So it increases the risk on the trade and personally doesn't make me very comfortable to buy a breakout with options. I'd much rather buy into a technical level with the thesis that an opening range breakout is possible on the day. So let's take a look at how I would actually execute just a very quick opening range scalp. That's basically just a trade that I take very early in the morning, sometimes within the first few minutes, looking to capitalize from that volatility, buying a dip essentially into a key technical level and scalping it back up into, for example, the VWAP or the moving averages, just locking in a quick little win for the day, giving me a little bit of a profit cushion on the day. And then we could possibly look at a bigger type of setup like that opening range breakout to play out. And I'll show you how you might actually look at executing an opening range breakout into a technical level with options versus actually waiting for the breakout to trigger. So let's jump over into our daily chart. Of course, we always want to start with our macro context. So we'll blow this up. And what I've done here is Apple was actually gapping up to around 130, I think it opened around 131.60, close to 132. So right here in this area, right? So Apple is opening up here, which is a significant gap from the previous day's close down here at 128.23. So that's like a two-point gap up right there. So significant gap. And of course, the first thing that we need to do is come to our daily chart and look for any obvious swing highs or swing lows. Now I've already got one marked out right here. You can see it's a minor swing high, but it is probably going to be significant if Apple pulls into it because it's really the nearest swing high where we had price move up and then we had this little bit of a pullback. So I marked out that 129.58 level as a very possible area for Apple to pull into. Now, it is a very long ways down. I mean, that's a pretty decent drop for Apple. So the odds don't necessarily favor it, especially given the very strong bullish thesis on the day, the bullish catalyst on the day. So probably it's going to find a bid before that. You're going to have enthusiastic buyers want to step in before that. So we mark that level. We know that if it comes into play, it's a very high conviction area to look at possibly going long Apple or buying calls. But is there maybe some intraday level in between there where we might actually find support and rally off of? All right, so let's go back over to our intraday charts. Okay, and let's kind of move this over. So we're just looking at pre-market before everything opened up and zoom out on the chart here. So again, that 129.58 was that swing high. So let's throw a line on here just around that area. Close enough. Okay, so there's that swing high from the daily chart right there. You can see from where Apple's opening, that's quite a ways away. I think Apple opened here, something like that. So you can see that's quite a ways away. All right, so if Apple beelines straight into that swing high, I would definitely like that, especially if it had a lot of speed and distance for a very high probability opening range scalp, and then possibly look for holding some for an opening range break. But again, that is a long ways away. So for more of a bullish thesis on the day, I would look for a level to come into play before that. So of course we go to our pre-market levels, mark out your obvious pre-market highs, pre-market lows. So we can come in and go ahead and do that. So your pre-market high looks like it's going to come in right there, and pre-market low, let's see, pre-market starts here. So the pre-market low is really the wick of this candle. Pay attention to those long wicks. A lot of times they will come into play. But what I do like about that is you can clearly see that there is support that comes in here from after hours the previous day, as well as here. So that level right there just above 130.5 is that pre-market low level, is probably going to have some type of interaction with it. And so I like that that's kind of halfway in between where we're opening and that swing high. So that would be a very high probability technical level for Apple to find support, at least provide a very quick opening range scalp just to make a little bit of quick money in a very short period of time, and then see if it comes back down and holds, or if it doesn't. And if it doesn't hold, then sit tight, let price come down into that very significant swing high or more important daily level. Remember, daily levels always carry more weight than your intraday levels. let price come down into that 129.5 area, and then possibly look at taking a second trade. Now, if we go, we've got those levels marked. We know what we're looking for. First, the pre-market low, and then that swing high. And it's also notable that there is a resistance level that you would maybe look to act as support from the pivot point study sitting right there. So when we move the chart over and just kind of look at this in hindsight before we go and look at the live price action video, of course, we can see that Apple does have that first move down, which is very important. We want to see that for an opening range scalp and potentially an opening range breakout. We must see that first move down. We don't want to see it rally. If it rallies, I'm not going to like it anymore. Okay, it needs to be down. That first move needs to be down. It catches support right here off of the pre-market low. Not super extended, but like I said, a very likely place for a technical bounce. If you wanted to buy right into that level and risk just underneath of it, you certainly could. And you can see that you would have been able to pay yourself nicely on this this one minute candle ripped all the way back up into the VWAP and the 9 EMA. We'll actually see the price action and how much those contracts expand in just that one little volatile move. And that's one of the great things about trading the open, but of course it is very risky. So this is something that you need to develop the experience to be able to do, practice with paper trading, take small size. All of these things are very important for you to do while you're learning and really focus on managing your risk, guys. I must stress that. But there's a quick example of an opening range scalp and how that would be played out. And again, it is just a scalp. I'm literally just looking for that quick snapback rally and I'm out. That's it. Okay. If I wanted to look for a possible opening range breakout on this to play out, once it has bounced here, now I know that this pre-market low level is obviously technically significant. It is being respected. Now I want to pay attention and see after this bounce happens, does price hold here and then maybe just rip higher, or does it actually pull back and then hold this level again, possibly a double bottom, or in this case you can see actually a slightly higher low. If it does hold there and then it starts to rally, then I know that the odds of an opening range breakout playing out from that point is incredibly high, and that would give me a lot of conviction to go ahead and jump into the trade. So if I was trading this with options, this is what I would be looking for an opening range breakout play after this quick opening range scalp. Look for it to pull back, look for it to hold a double bottom or a higher low. And whenever it does, you can see that it pulls back, right? 3 red candles down. The next candle is green and comes up. So it's showing me that it's trying to hold this higher low. When you put in a new high here after the pullback into the higher low and it holds, there's your trigger, right? There's your trigger to expect that opening range breakout to happen. And buying here, you're getting a much better entry before the extrinsic value in those options contracts really expands versus waiting for the opening range breakout. Again, opening range breakout technically triggers here, right? Here's your opening high and your opening price. Price pulls back off of that opening high, and then it rallies up through it, right? And so the opening range breakout technically triggers on the break through that. Okay, so at that point, you're buying up here, right? And so I just personally feel more comfortable buying off of a technical level here versus buying the breakout here when I am trading options. So that's the idea of both of those trades. Let's take a look at the live price action and see what it actually looked like as it set up in real time. All right, guys, so the market is about to open here. We've got Apple's chart up here. We're going to be paying very close attention to this. Again, the idea for my opening range scalp is to look for Apple to pull immediately off the open into that pre-market low area around 130.5. And then below that, we have the swing high from the daily chart around 129.58. So the idea is, again, that Apple's probably going to have some interaction first with that pre-market level, which could provide us with an opening range scalp. And then if that doesn't hold and it comes down to that swing high, that would be an even higher conviction trade to execute there. Now, I would anticipate that if it does come down to that 129.5, that swing high from the daily chart, it's first going to interact with a pre-market low, which is going to give us a very quick opening range scalp trade. And then we can reset and look and see if it comes back down down and holds that pre-market low, as we know it does with the benefit of hindsight, or if it beelines even further down into that swing high at 129.5. So what I want you to pay attention to here is watch the ask and watch the time and sales here coming through on the option contracts. I want you to see how those premiums on the 130 calls really start to kind of lose a lot of value as you have this volatile push down here on Apple stock. And what I do with a scalp like this is I look and I watch the ask. Okay, I'm looking for the ask to continue to dip as Apple is coming into my level, and I'll begin to start scaling into my position. So here it is. Here's the level, right? I'm watching this as Apple is washing down. I'm watching, and as it comes into my level here, I'm starting to buy. And then as it pushes down through the level, a little bit of a momentum overshoot, I'm buying some more, right? So I'm scaling into my position a little bit at a time. I apologize, I switched over to the 129 calls, but we're going to go back over to the 130 calls here in a minute. I was actually trading something else this day, but this is a great example of how I execute these opening range scalps. So we're coming through the level here. Again, I'm scaling in to the last bit of my position, expecting this little bit of momentum overshoot, not uncommon to see. And again, what I'm looking for is a bounce off of that. You can see we do have some extension away from that VWAP and the 9 EMA sitting up here. So I'm looking for that clear interaction, that bounce off of that level. Look for a scalp back up into your VWAP and your 9 EMA, and that's it, you know. But if this second 1 minute candle opens and continues to wash down, I'll just get out. I'll just get out and reset down at that 129.5 level, that swing high, because that's probably where it's going to go. All right, so we see that the low on those contracts hit 167. Now look at this. Look at the time and sales coming through on those contracts. It's already up at 190, almost $2. There's 195 on this bounce right here, right? Just this one minute candle coming up. Look at that, $2, $2.02, 205, boom, 211, 210. Look at all that, those orders coming through above the ask there, right? So 220, look at that, 220. Now, I'm not saying you're, of course, going to bottom tick right at 167, but where I started buying was about 180, right? As Apple was coming down into this level, I was starting to scale in around the 180 price range on the premiums, would have been averaging down on this little move through that level. And now look at where the premiums are, $2.20, right? 40 cents from the $1.80 where I initially started to buy. Even more if you got an average a little bit lower than that. So just that one minute candle, just that one minute candle bouncing up off of that, you just got a huge scalp trade out of that. Now that's what I call the opening range scalp. Now again, you have to have proper bullish context. You can't just be, catching a falling knife, so to speak, on some random stock. This is a very bullish stock. Apple is one of the most bullish stocks in the stock market. It had a bullish positive catalyst on the day. It was gapping higher. There was a lot of bullish context there for Apple to see a move higher on the day. But what I want to see, I always want to see, is that first move down. Okay, if Apple opens and then it just rips, there's no trade there for me. There's just no trade, not a long trade. I need that first move to be down. And so very nice, very quick scalp, able to get quite a bit out of those option premiums on just that one minute candle. And as I said, when you're trading early in the morning like that, that's literally a trade in the first 2 or 3 minutes. It's very volatile, right? You're not trying to hold for some huge move at that point. You're taking quick gains and you're getting out. You're in, you're out, a minute or two tops, and that's it. Now what you want to do is you have the strong bullish context on the day. So we know that there's a good chance that Apple will probably see a move higher, right? So now we want to see this opening range establish itself and then give us a trigger to possibly take an opening range breakout. Now, if I was trading a stock, traditionally the way people would trade this, an opening range breakout, you have your opening price here and the initial opening high right above that, right? So a traditional opening range breakout is to see price break above that opening price, and then that opening high there, basically going from red to green on the day. That would be the trigger traditionally to take an opening range breakout. However, with options, when you buy high like that, the extrinsic value is going to be inflated at that point because it's already had obviously a big move off of the lows by the time it gets up to there. So I like to try to anticipate just a little bit and look for obviously that key technical level to hold. So right now that key technical level is around that pre-market low, which is also our low of day, right? So I'm watching as price is coming down, right? It's just pulling back, nice and calm. The volume is just kind of relaxing a little bit here on the pullback. That's perfect. That's what we want to see. So what I'm looking for is to possibly double bottom or higher low. And so I watch this as it comes down, right? As price comes down, I watch and see, does it hold this low or does it break? And if it breaks, I know that it's going to that swing high, that 129.5. So we'll sit tight and wait for that. So we have 3 candles coming down. Now I'm looking for the first green candle to show me that it's going to hold either a double bottom or a higher low right here. So I'm still just watching. And this is where it's very important to be patient, guys. Don't try to jump the gun too early. Let it prove itself. We are trying to anticipate a little bit, but we don't want to jump the gun too early, right? You don't want to necessarily jump in here and just, kind of gamble that that is going to be a higher low. Let it prove that it's going to be a higher low. Okay, so we're starting to see the first green candle pop up here after these 3 red candles pulled back. So now we want to let this candle completely develop. Let the candle close. That's very important. That's your confirmation. The candle needs to close first and then look and see what does the next candle do. All right, so the candle closed. So now we have a clear trigger. Breaking that high is the trigger. That's your trigger to get into the trade, looking for the opening range breakout because the higher low is proving that it's holding. All right. So we're watching. And again, it's very important to pay attention to the momentum. Look at the tape. Look at the flash of green coming through as it pushes through. Boom. That's your trigger. Get in that trade. And at that point, your risk is clear. It's there, right? It's that higher low. You could risk low of day, but at this point, it's going, and if it in fact is strong on the day and you're expecting that opening range breakout, it should not break this higher low there. It should not break that higher low. So that's your risk, right? That's virtually no risk from where it triggered here to here. That is not that much risk compared to waiting for the breakout to trigger, right? So the breakout triggers up here. It still hasn't triggered yet, right? But you're already in the trade with some option contracts. And of course, you want to pay yourself something here just in case it doesn't break out, just in case the opening range breakout doesn't play out yet. But you're already in the trade with a much better entry, right? Look at the premiums. Look at the premiums right here as we're pushing up into the opening range breakout triggering. The premiums are already 255 there on the ask. Let me just rewind the video a little bit so we can see what it was at the entry points. Let's go back. Okay, here we are. So the premiums right now are 209, 215. Boom, right there. Okay, you see the flash of green coming through. New high put in. It's triggering. You're buying right now. Call it $2.18, $2.20, something like that, right? So you're in the trade right now. $2.15, $2.20 roughly is about what you'd be paying when it triggered right here, okay? And so your risk is clear. You're risking here. You're sitting tight. You're sitting pretty. And let's see, what are those premiums? I think that it was 250 or so as it pushes up into that initial opening high, that opening price right there. As it pushes up there, it looks like it's right around 250. Yeah, 240 on the ask, 240 coming through on the tape. So we're up over the VWAP now. Look at it coming through 245, 250. Big orders coming through there at 250. So yeah, you were getting in what, like I said, around even 220. You just got 30 cents on the premiums and just this little move right there, right? So you're sitting pretty with a much better entry. For me personally, it makes me a lot more comfortable to buy low like that versus waiting for the breakout to trigger. Because now once the breakout's triggered, you're buying over 250. You're buying 260, 265. You know, you're buying, and I apologize, I'm taking a screenshot right now for the chat room. But yeah, you're buying much higher on the premiums here than you were down here. Okay. So now that the breakout has triggered, if someone was trading the stock, you know, obviously the clear breakout right there is the trigger to get into the trade. But what's most likely to happen here is that price is probably going to have to pull back and prove that this can hold support before it really continues higher. Okay. So if you missed this, if you miss this here, what you could do is wait for this here, right? Wait for this pullback right here. So we're sitting tight. If we're already in the trade, we've paid ourselves some here through that opening price, okay? And then you can see that there is some resistance coming across here from pre-market. I don't believe that's the pre-market high, but we do have some, obvious resistance that came into play there around 132.25. So I'd be looking at definitely taking some more off on any push up into there. And then you could really leave a good piece on to see if you get a big move higher, which of course with the benefit of hindsight, we know does happen. But obviously you're able to see this opening range breakout playing out here in real time, okay? So you see that price is struggling a little bit here after the initial breakout, right? So what did I say? It makes sense that price probably needs to pull back a little bit here and prove support before it really finds even more legs to continue higher. So let's just see this play out a little bit longer here, right? So you can see the tape here, and you can see the option contracts as well. So I like to pay attention to both of them, right? We're trading options on the underlying. We're basing our trades, our targets, our entries, our risk. All of that is being based off of the underlying, off of Apple's chart. But it's still, in my opinion, important to be paying attention to the option contracts. The orders actually coming through there on the time and sales, the bid-ask spread. It's very important to be paying attention to that because, that's the instrument that you're trading, of course. But we are still basing our trade off of that underlying chart. All right. So again, I apologize, taking another screenshot here. So as Apple's pulling back, as I said, there's your opening price. Okay, so we're seeing the pullback. Now what we want to see is that hold, okay? If that doesn't hold at that point, if I was in the trade from here, and if this doesn't hold, if it falls back down here, you got to get out. Because at that point, all of the longs that bought this breakout right here, if this doesn't hold, if it comes back down here, they're going to bail. And the premiums are going to fall apart in a hurry, okay? So we're sitting tight. So far, the trade looks great. If you miss the entry here, this is what you'd be looking for. You see that this pullback into support is holding, and you could try to get in here. But again, I much prefer to do it lower, but there's absolutely nothing wrong with that. With options, I would rather just wait for it to prove versus buying the breakout through that initial high, that opening price, because what's likely to happen is it's going to pull back. So if you bought here, right? If you bought here on the breakout, you're going to go red on this pullback here, right? Now, you'd be fine here by the time it bounced, but just let it pull back. Let it prove itself and then buy it, okay? So as we see the opening range breakout playing out here, very nice breakout play. And we know, again, with the benefit of hindsight, it does continue much higher on the day. But this was a really great example, guys, of what I call an opening range scalp, given the proper bullish context on the day. And then versus kind of waiting for confirmation off of a higher low or a double bottom off of that key technical level for a potential opening range breakout and looking for that bigger move. Obviously, you want to be taking smaller size if you're looking for that bigger move and you're expecting to hold for a longer period of time versus something like this where I'm taking just a quick opening range scalp. I'm going to be getting in with size because I'm only taking a small move. I'm getting in with size and I know that I'm here, right? That's what I'm looking for. That's it. That's my trade. So it really just depends on the style of trading that best suits your personality. I prefer quick in and out trades. That's me being a scalper because I like to be in and out of the market as quickly as possible. That limits my exposure. And then if I want to go for a bigger picture trade, of course I can take smaller size because there's a lot less risk with that smaller size. And then it gives you a little bit of patience to really kind of hold on for that bigger picture move. But it's just not really my style to do that, so I don't do it that often. But it might be yours. That's why I wanted to give you this really good example of both ways that you can trade something like this. So hopefully it was helpful. Let's go and look at some other strategy examples now. All right, guys, so this is an example of a flag breakout that I was looking for on PLTR. It is on the daily time frame, so of course we always want to put more emphasis on setups off the daily time frame. We see that PLTR had a big run up. It's been consolidating. There's your all-time high, and then the flag anchored there to that lower high. So you can see clearly that this creates the flag that we look for on a setup like this. There's your flag. And on the day I was looking to trade this, we were gapping up over the flag. So what I wanted to see was a pull in the morning down into the flag area, see if we couldn't grab it long there, and look for hopefully an explosive move higher. And unfortunately, you know, it did not work out like that. I was able to make a nice profitable trade on it. So I'm going to show you how I actually executed the trade. We're going to be looking at the live price action here in just a minute. I traded the stock instead of options. So you're actually going to be able to see the executions on the chart as I'm trading it. So that was the idea. However, I was noting that this 28.26 level was a minor swing high right here. So that was going to be one of the levels that I was going to be looking for. And that's falling in line right there around where that flag is on the daily chart. So as always, we start with that top-down view, then we want to go to our intraday chart and see if there's any potential levels that we need to be aware of in between there. So we blow this up and just look here at the pre-market. You can see that the pre-market opened right here, and there was also some kind of basing support that came in throughout here in after hours, right? So this level around 28.60 or so. Let's see if I can draw this across, right? So this level right here is right around where pre-market was opening. So that's really the level that I was going to be looking at. That's your pre-market low, essentially. That was really the intraday level that I was going to be looking at in between where the flag comes in and that swing high that we just saw on the daily chart marked out there at 28.26. So the way I wanted to play this was to start a position here into that 28.60 level, that pre-market low, pre-market open price area. See if that holds. If it doesn't hold, then I will just get out of the trade and reset and take a second entry down here into that swing high at 28.26. All right, so let's jump into the live price action and see how the trade was actually executed. All right, guys, so the market is just opening here. Of course, we're looking at the chart here for PLTR, and then we have the time and sales, level 2, all that good stuff over there. And I also have a white chart up in the top right corner of the screen. That's from my brokerage platform, so you'll be able to actually see my executions because I traded the stock instead of options. So as PLTR is making that run down into the pre-market low, that pre-market open price, this is where I'm going to be looking to essentially buy the dip. I'm looking to get into the trade there. If it doesn't hold, if it shoots right on through it, just get out of the trade and reset back at that swing high that we marked out just a little bit lower. You can see that I just executed, right, buying into the level, trying to anticipate it a little bit. Not uncommon to see a little bit of a momentum overshoot here. What I want to see is the next 1 minute candle, if it holds this low or if it breaks it. So we've put in a low here. We're starting to bounce up a little bit. So this next 1 minute candle is very key. If it comes down and breaks that low, then I'm just going to stop out. I'm just going to take the trade off. But as long as that low holds, I like it, and I want to see if enthusiastic buyers really come in and start buying it up, looking at that potential flag breakout from the daily time frame. So as you can see, there's my entry, and we're just watching the price action here, and this is where it's very important to just pay attention to how the price action is behaving, right? What I want to see is I want to see a definitive bounce up here, right? That's going to tell me that buyers are really stepping in. Any shorts who chase this down are obviously going to be getting nervous, and they're going to start stopping out, and we could easily get a significant squeeze higher. But the longer that it kind of struggles here to bounce, the less and less that I'm going to really like it. However, I know my risk. It's right there, okay? This 1 minute candle is coming down. I'm watching it very closely. Again, if it breaks, I'll just get out. No big deal. You just have to take the loss and move on. You have to be comfortable with taking losses, guys. It's just going to happen. So we can see that it's trying to hold, but we haven't really got much of a bounce out of it, okay? And so we just kind of watch the tape and see if any significant buying momentum comes in. So far, not really seeing any signals or any conviction that it's really going to hold. In fact, you could almost say that it's starting to kind of bear flag here, right? So if we don't bounce, then it's going to kind of reaffirm that we're bear flagging, and it's probably going to make another run lower. And I'm going to be looking at that 28.26 level, which was that swing high that we marked out on the daily chart. So you can clearly see that it's struggling here, right? I mean, it's holding, but it's flagging. It's all it's doing. It's just flagging here, just not seeing any indication that it's going to hold. But I'm in, and I know my stop. I'm watching the tape very closely here. Let's see if it gives me a signal. I'm watching. And look at that momentum coming through, all of the orders coming through on the bid. I'm out, right? Just like that. You saw that momentum coming through, that flash of red. That was telling me that sellers were hitting the bid. They were just literally hitting the bid and getting, just selling right there. Short sellers, chasing this down as well. So at this point in time, it's coming down to this 28-26 level. So take the loss, get out, reset, and look at getting back in here at this more significant level from the daily chart. And that's also right about where that flag comes in as well. So sitting tight, all right, and you'll see my execution here again on this chart as we wash down into that 28-26 level. I'm going to be looking to once again initiate a position there and see if that level, which is the more important level, will give us a nice play off of that and look for a potential move higher, maybe even an opening range breakout as that flag breakout plays out from the daily. All right, so as we wash down into that level, you can see that I just executed once again, and now I'm in exactly at that technical level, which gives me very clear tight risk. I'm watching the price action very closely here. You see all the green coming through, right? So you start to see a lot of shorts covering. You see some buying coming in, which of course is causing the price to rise here. We've got some nice extension away from the 9 EMA coming up right here. What's most likely to happen is that price is going to come up into this low, this initial morning low, that pre-market low area. The most likely probability is that price is going to come up into there and back test that. And that's where I want to be taking some profit. Because if it retraces up to here and then fails and comes back down, at least I took some risk off here. I took some profit off the table, and then I can still keep my stop right here at low of day, right? So as I watch this come up, you see that I tried to put an order out just ahead of that initial morning low, but I don't get filled, right? So I end up pulling the order and decide to just sit tight because I got such a good entry here that, I might as well just sit tight and see if we can't get a better fill right up at that level and just keep our risk, just keep our risk right there. It's not a big deal. It either works or it doesn't. That's all there is to it, guys. You take it at technical levels and it works or it doesn't, right? And especially given the right context, that's also important. You're not just randomly buying a stock into any random level. We had the context. We had that flag breakout potential in the daily chart. So there was clear context there that I was playing off of. All right, so as we're continuing to hold, starting to form a little bit of a hammer candle here on the 1 minute, looking good, price picking back up. So I think I'm about to throw an order out here in just a minute. You can see on this chart here. And I believe we'll get filled here in just a second as we're pushing up into this resistance level. There it is. Okay, just sold some of my position right there, just as we had planned. And now what I want to do is sit tight and see if we can get a move higher, because what's going to happen here is anyone who is short, who chased this move down and who chased this move down, they're going to get nervous if this breaks right here, right? If price pushes up here, they're going to start getting nervous. They're going to start stopping out, and that should help price squeeze up through, through the VWAP and probably into this opening range. This is your opening price, your opening high. So it should help price get up higher there. So I know that that potential is there. So I'm just going to sit tight and see what happens here. So we're watching, and this is where it's very important to be patient. Let the trade play out, especially when you get a really good entry. Pay yourself something, take some risk off the table, nothing wrong with that, and then sit tight. Look for that bigger move higher if you can. Okay, so it's not a very long trade. We'll see it play out here. Now you'll notice that what I did is I went ahead and just placed an order above the market right here, just ahead of 28.80, and that's because that's going to be right here, right around where that VWAP's coming in. Right, so I'm kind of thinking that if we get a squeeze up into the VWAP, that's a potential place where price could reverse, where more shorts might try to pile in there. So we just want to go ahead and try and place an order out there, see if we can get that filled. I think I moved it up just a little bit there. Yeah, I moved it up just a little bit. So we'll see what happens. I'm not sure. I can't remember what. Oh, I changed to Apple. That's the problem. Sorry about that, guys. We're still looking at the chart, though. We're still looking good. We are starting to move back above that initial morning low. So everything looks good there. So mark that out again. There's your initial morning low. We are moving. You can above it. You can see that we held it here as support. Looks good. Looks really good for this push up into the VWAP. And right there, see, I just took some profit right there as price was coming into the VWAP, right? So perfect. Now I still have one more order sitting out right here just above that. That's coming into this kind of 28.94 level here that I had marked out from the daily chart. Looking to take a little bit more profit there because it's not uncommon to see price kind of overshoot the VWAP. What could happen here? We've had a nice retrace, comes up into that daily level, just got filled on that, and then price might want to come back down here. So I want to make sure that I pay myself on this nice little run up here, and then if price does pull back to here, I'm still sitting pretty and still in the trade, but I want to see that hold if that happens. Otherwise, we're approaching an opening range breakout right here, right? There's your opening range breakout trigger. Now, here's the catch, guys, right? With an opening range breakout, you don't want to see it break out after making an extended run like this, okay? I mean, if we look at this, this is 1, 2, 3, 4, 5, and so far 6 candles, 6 1-minute candles, pretty much going straight up, okay? So if you have a stock that literally just goes straight up off of the low, back up into that opening range breakout zone right here, that's not an opening range breakout that I'd want to buy. All right, because even though, and we're going to see this, even though there's a chance that it will break out here, and in fact it does, with the benefit of hindsight, we know that it does, the odds that it's just really going to have a significant move higher without any kind of a pullback is slim to none, right? Because it's already made a big move here, right? This right here, this is already a nice move. And what we're seeing here, this is shorts, really. This is short squeeze, right? Because any shorts who chase this move down, it's breaking up over the opening price. It's gone from red to green on the day. So those shorts are bailing. They're getting out, right? So what's going to happen is you're going to see shorts kind of squeeze out of their position here. Now, initially, what I thought I was going to do is place a stop order at break even because it looked good. But then I noticed, look here, let me just back up the video a little bit for you, because what I want you to pay attention to is the level 2. Okay, so over here, this is the ask side for the level 2, and you're going to see some really big orders start to show up on that level 2, which tells me that there's a lot of technical sellers looking to dump their shares on this run up here, on this extended run up here. You've got some overhead supply here from pre-market. You've also got the 29.5, which is your whole and half dollars are psychological support and resistance. So you have this extended run up off of the low a day. It's coming close to this 29.5, which you know is going to be psychological resistance. You can see the supply here from pre-market, and this extended run with no pullback, just generally favors that it's probably going to pull back. Okay, so at this point, I decide to remove my stop from break even and go ahead and sell my position when I start to see all of these big sellers showing up here on the ask. So let's unpause the video again for you. All right, so take a look here. Look at that 156 there. It's moving very quickly. Let me see if I can pause it one more time for you. All right. Somewhere you can see right there 100 as we're pushing up, pushing up, pushing up. Look at the squeeze. Look at the squeeze higher here. We're at 29.40. So we're almost to that 29.5, and I've already sold out here, so I just missed it. Let me just back the video up again for you here. Just before I sell. So it's coming up. Man, it happens so fast. It's real easy to miss it. There it is. Look at that. So you see 300 right here, and there was some even bigger orders. So there's a lot of sellers sitting up there at 29. Let me just unpause the video again for you here. Right, 300 at 29. Okay, we're moving up 2006 there. We're still seeing a lot of big orders here, just above that 29. So when I started to see that, and again, given the extended nature of this move and the fact that an opening range breakout in this fashion is unlikely to really work, that's when I decided to just go ahead and take the rest of the position off. So as we're pushing up here, you can see I'm about to sell right up here into 29.20 area, I believe it is. Yeah, so I've got an order out. No, not yet, not yet. Coming up here. See how it's struggling? Look at how price is struggling, right? You see this, see price really struggling here. There's a lot of sellers stepping in here, right? One more push up, and you can literally see it in the candle. Look at the candle popping up and down, popping up and down. It's pushing up, but it's still, oh, right there. Look at that. 176 right there at 29.30. So that's what I saw right there. That was hard to catch, but yeah, that's what I saw when I saw all of these big sellers stepping up at 29 and then 29.30. And given this extended run here, again, the fact that it's unlikely the opening range breakout is just going to continue without some kind of a pullback, that's when I decided to just go ahead and take it off from there. So unpause the video and you'll see that my order comes through here in just a second. Right there, just hit the bid, just got out. You know, so really good, a really good trade, really good example also of paying attention to not only the chart and the fact that, you know, this is just getting extended at this point. It favors some kind of a pullback, but also paying attention to the level 2. What is it telling you? Where are a lot of big technical sellers starting to show up on the market depth there that might give you some hint as to, you know, where the stock's most likely going to struggle. You combine all of these things together to give you, you know, the best idea of what you should do with the trade. The fact that it's coming up into that 29.5, which is going to be psychological resistance. The fact that you see those big technical sellers in the level 2. The fact that it has this extended run through an opening range breakout that is just unlikely to continue without some kind of a pullback. All of these things coming into play led me to decide to go ahead and take the trade off. And as you can see here, really good decision that was, because we're getting now a significant pullback and we're already back below really the opening range here, right? There's your opening range. And look at the size of that candle, really getting stuffed pretty hard there as the technical sellers, all those big orders that we saw, those technical sellers really driving the price back down. So so that's a good example of a particular trade that I was looking at with a flag breakout potential on the daily chart, and how I executed this trade, and a good way to kind of see the executions on the chart. The benefit of trading stocks with a Lightspeed platform. Unfortunately, option trades, they don't have option charts, so you can't see your executions on a chart. But hopefully this video did help you in that sense, and we'll take a look at another example now. All right, so now I want to show you what I like to call a contrarian scalp. All this is a counter trend trade. We're simply looking for a stock that's made an extreme move. Basically, you got some nice extension away from especially that 5-minute 90 EMA. That's your 90 EMA on the 5-minute time frame, and the VWAP as well. So the stock, preferably for me, I like to buy dips. So the stock has sold off. It's sold off with speed and distance away from those moving averages. It basically creates an imbalance in price with a high probability that it's going to bounce off of the next technical level. Now, when we trade counter trend, for me personally, the way I like to do it is to kind of have a point, a key technical level where I'm looking for the stock to sell off into, and where I will start in on a trade there by, for example, I'm buying dips, so I would buy calls. And then I would have some level below that entry point level, where is my ultimate risk level. So everywhere between where I'm initially getting into the trade and where I'm risking, everywhere in between, I will scale into my position. Now, it's very important that you consider the risk on the contracts that you're buying. So again, we can look at the delta, and we know that if the delta, in this case on the contracts I'm looking at here, I have the 600 calls open, so the delta is about 48 cents. So I know that for every 1 point move that Tesla drops, these 600 calls are going to decrease by 48 cents. Okay, so I can basically calculate out about how many contracts I can take within my planned risk zone where I'm planning to get into the trade and where I'm ultimately risking. And so that way I can scale in up to my max contract size until the stock hits my ultimate risk level if it gets there. And basically all I'm looking to do is to capture a short-term reversal in the trend. So right now, the trend is down on an intraday basis. Now, remember, guys, that I'm not buying dips on just any random stock here. I'm buying dips on some of the most bullish stocks in the market. Tesla in particular is especially bullish this year. So it has strong macro bullish context, but of course, stocks don't go straight up all the time. They're eventually going to have some technical pullbacks, and that's what we're seeing here. So as Tesla is looking pretty weak, we're looking here at a 2-minute time frame. Up at the top here, I have a 1-minute time frame, so you can kind of monitor, here's your 9 EMA, that fuchsia line on your 1-minute time frame, so you can kind of see that as well. We'll switch back and forth here between a 5-minute and a 2-minute time frame, and then over here I have a 60-minute time frame pulled up. So you can see the tape here for the underlying for Tesla stock, and you see that I have those 600 calls up right here. So as it's looking weak, it's looking to flush down. Look at the calls trading around 23.5 as that volatility comes in and it makes this move lower. Look how the premiums really get crushed. Look at the speed coming through there on the tape on the underlying. Look at the premiums, they're starting to come down, so they dropped already a point in value on those premiums. And what I'm looking at here on the 60-minute chart, you've got that pivot point and the previous close sitting just below us. So kind of like a confluence of support. You have two possible technical support levels coming in there. In addition, we're starting to get some nice extension here. Not quite yet, but we are starting to get some extension. We're getting that distance away from the moving averages on multiple time frames. Not really the 1 minute just yet. But we are starting to see some nice move lower. And as we come into that first key technical level, that pivot point level where I'm looking to initiate my first buy on this trade, you'll see that I actually hit my button right there to buy one contract. I got filled at $21.40. Now we still see that there is a little bit of momentum. I'm a little early and I know that, but it's all within my trade plan. So the plan is to start in here. As we just saw, I bought one contract. But I'm ultimately going to risk all the way down here. Down there, you have the previous day's low and you have your first support level from the pivot point study. Now, I know that that certainly looks like a long ways away, and it is a long ways away. But again, I've calculated out how much risk I can take by buying the right number of contracts throughout that area, looking for that counter trend play. Now, I don't know exactly where it's going to occur, but I do know that the odds that it's just going to beeline straight down here without stopping at all and just keep going is just incredibly unlikely. So I'm perfectly happy to work within this area here to essentially scale into a position. So I start into the first key technical level and I risk here. If it keeps coming down, I'll add again down here somewhere. And then if it comes all the way down to my risk level, all the way down to that prior day's low there, I will add in one more time. So I've calculated out ahead of time that I'm willing to take up to 3 contracts on this trade, beginning here at the pivot point, the previous close. If it continues lower as we're seeing, what I've done is I've placed an order out at $19.40, which is actually $2 cheaper than where I first bought at $21.40. So I'm doing that. If we see this volatility continue, we're breaking below my first entry point, that first technical level there of the previous close and everything. What I'm doing here is if we get this volatility coming lower, you see the premiums really dropping in price. I'm going to see if I can get a really good entry on that second ad. And you'll see that I did just get filled there. So I got filled at $19.40 on the second contract, which brought my average cost down to $20.40. So as we continue to wash here, we're looking at the 5-minute chart. We are starting to get some really nice extension, both on the 5-minute time frame as well as in the 1 minute. Okay, so as we watch the tape here, you'll see how it kind of sped up as it was washing lower, but now it's going to start stalling, right? It's starting to stall a little bit. It's starting to slow down, which is telling me that, okay, short sellers are starting to cover some of their position. They're obviously taking some profit on that nice move lower. You've got dip buyers stepping in as well. So you see how the tape really stalled. It really slowed down. Now it's picking back up. And I'm watching this closely here. looking to see if we can start to get a nice retracement back up. And on any type of a trade like this, my usual target is to get to that 5-minute 9 EMA. So that's why we want that extension on the 5-minute chart, because ideally the target that I love to hit is that 9 EMA on the 5-minute time frame. So we've got the extension. You see how the tape slowed down, and now it's starting to just kind of pick up a little bit as we start to bounce, and I'm up to 2 contracts. Again, we haven't gotten all the way down to my risk level here where I would add 1 more contract if we got there, because I know that if we do flush 1 more time down to that level, that it's really going to be extended by then, which is going to be even a higher probability that we're going to get a significant bounce back up. And it actually would have been a bigger winner if I'd gotten down there and gotten that 1 more contract. But because Tesla is so bullish, aggressive dip buyers just come in so quickly on this stock that you're going to see that it actually ends up bouncing from this point. Now, it doesn't always happen this fast, but in Tesla's case, because it has been so bullish, it does give a really quick retracement here. And this is about a 5 or 6 minute trade, and I'm able to make, over $500. So that's not bad at all. So I've got 2 contracts based on the premiums. I was down at most about $200 or so on the position. So really not that bad considering what I'm going to get out of the trade. So the risk reward ended up panning out really nicely. Look at all the flash of green coming through on the contracts here as we're bouncing up. So what I did there is I actually sold one of my contracts about $1 above my entry. So let me just back the video up a little bit. So you'll see here that I placed an order out right here. I'm placing an order out at $22.40, and that is $1 above my first entry at $21.40. And so what that's going to do, so I put it out above the market and let the market come up to me. You'll see that it's coming up right now. And so the order, we're sitting at 22 on the ask, and the time and sales coming through here should be fixing to get filled. And I guess I already got filled. I missed it there, but so I got filled on that 1 contract. And what that did is it locked in $100 gain return rather on that 1 contract, but it wasn't so much to take profit as it was to reduce risk. So since we're starting to get that bounce, at this point, I no longer want to risk all the way down here because we are bouncing. We're already getting the bounce that I'm looking for. So now I've moved my stop on the trade to low of day. If it breaks low of day, I'm just going to go ahead and get out because it's already bouncing. I was only going to risk all the way down here if we just kept going down there without bouncing. So that's why I kind of scale into these trades, because, they don't always hit these levels to a T. And so this way I'm able to capitalize from the trade, and by very skillfully, scaling into the position as it comes through those key technical levels that I'm watching. But once it does start to bounce, now we need to adjust our risk on the trade. So I sold the 1 contract. I locked in $100 on it. Again, not so much to take profit, but to reduce risk on the trade. Now, what that's done is it's left me with 1 contract left with a much better average price. My average price in that 1 contract is $19.40, and you can see the premiums are trading over $23 now. So that's already a really nice jump on the premiums from that average price that I'm sitting at. So now I'm sitting pretty. Now I really want to try to milk this last contract that I have up into my profit target, which is that 9 EMA on the 5-minute time frame. You can see the 5-minute time frame right here, and the 9 EMA kind of curling down. It's sitting up around 590, 470 at the moment, and the VWAP sitting right there with it as well. So what makes sense is we see kind of a retrace back up into that 9 EMA on that 5-minute time frame, and that's where I want to take the profits. Now, it is important to look at other time frames, of course. So, of course, I'm looking at a 2-minute time frame here. You can see the 9 EMA there. The 2-minute time frame is good. It kind of cuts the noise down in half from the 1 minute, but you'll see on the 1 minute here, we retraced up into the 9 EMA, and right now what we're looking for to see is, can we continue the move back up, or are we going to roll over here and break lows? And if we do, that's why I said I've moved my risk on the trade now. I'm no longer risking anywhere underneath of this low here. All right, so what we're watching very closely here are these premiums. They were trading around 23. They've dipped down about a point here as we're starting to stall out. So I'm watching this really closely. I'm thinking, all right, it's holding up. I still think that I can get my profit target. Let's let the trade play out. I really want to stick to the trade plan here. I don't want to let one candle spook me, right? So we're starting to see this little bit of a pullback here. I don't want to get spooked out of this trade yet, because even though it's starting to pull back a little bit here, it could still very well continue higher, because going back to that 5-minute time frame, look at how much space we still have here. Okay, so there's still the potential that it could bounce up a little bit more, and that's what I'm looking for. That's the trade plan. I want to make sure that I stick to that plan. So as we bounce back up here, premiums are back up around 23.5. I'm watching this very closely to kind of get an idea of where I can get out of the trade. So we see that this 5-minute candle here just closed. So right now it looks like we're probably going to get one more small body candle up into the VWAP and the 9 EMA, and then it might roll back over and come back down to test lows. So I want to make sure that I get out here. I want to make sure that I go ahead and take my profit here. So you'll see that I put an order out at 23.85. And I just got filled. And the reason that I did that is because, again, I was watching the premiums very closely this whole time, and the ask was hovering around 23.5. So we always have to consider the spread as well, the slippage on the trade, right? What is the difference between the bid and the ask, and where can you realistically get filled? It looks like I could have got a little bit more out of the trade. You know, the ask jumped up to 23 or 24.5. And you can actually see orders coming through 24.5, 24.70. So, you know, I could have gotten filled maybe 80 cents or $1 more on the premium, but realistically, is it really worth that? Probably not, right? I still was able to lock in $545 on the trade with those two contracts, and the total drawdown was about $200, maybe just a shy over $200. So really not that bad of a return, considering I was only down about $200 at any point during the trade. So I sold on that push up here. Like I said, you know, for me, I'm perfectly content with my exit. You're never going to top ticket perfectly, but a really good example of this contrarian type of trade where you have strong bullish context. Of course, like I said, we're not just randomly buying dips on any stock. We're buying dips on bullish stocks that are just simply having a technical sell-off. They give us that clear edge with speed and distance away from those moving averages, and just that high probability that it will bounce back up into them. And that's what I'm playing off of. Now, does it work all the time? Of course not. If it's a news-driven play, then it's something you never want to touch. Like if some kind of news comes out on a stock and you just see it just tanks, right? It just sells off real hard. It gets like beyond extended. I would just recommend not touching anything like that, because it's very emotionally driven when it's news, and it will go right through technical levels like they're not even there. So if it's a news play, avoid it. You never want to be trying to trade counter to a trend whenever it's news related. Also, if the entire market is really selling off with, you know, a lot of volatility, you're looking at your market internals and it's just a really bearish day. You know, it's like -4 to 1 or something on the New York Stock Exchange and the NASDAQ, whatever the case may be. If it's just a really bearish day in the entire stock market, those are days when you really should not be buying dips. This is not one of those days. It's not a news-driven play. This is just simply a technical sell-off, a technical pullback on a very bullish stock. Given that context, it makes sense to buy dips. That's what people are doing on these stocks. They're aggressively buying these dips. And so I'm essentially just capitalizing on a tiny move. That's all I'm doing. I'm scalping a tiny move, a very high probability move, which is great for me. I prefer to take very high probability trades that I know I'm right on more than I'm wrong. So that's just my style of trading. It might not work for you, but this is a really great example of how I go about executing such a trade and the type of things that you would want to look for as well. All right, now let's take a look at an intraday flag break. So this is basically a breakout setup, and we're looking for a flag pattern to establish itself. And it's always important to consider the macro context with these type of trades. So in other words, we're not just taking any random flag breakout, right? Especially when we're talking about trading options, because when we buy breakouts with options, it's going to be more risky, right? Because we are essentially buying high instead of buying dips into, like I like to do, for example, the Contrarian Scalp or opening range scalps, for example. So for some context on this particular trade, I'm looking at Amazon, and Amazon is a tricky stock to trade, especially with options, because they are very, very expensive. Now we see Amazon is trading just a little over $3,000 a share, around $3,015 a share. And so I actually have the 3,100 calls open here. So I'm almost 100 points out of the money. And you can see why. Look at the price of these contracts, $4,500 for just one contract. And that's even going with the 3,100 calls, right? That's going really far out of the money. So sometimes on Amazon, for example, the stocks when the contracts are very, very expensive, I will go pretty far out of the money if the setup is good. If I have a high edge, a high probability setup like this one right here. So also 3,100 being a very big whole number, those contracts will typically trade more volume. So it's going to be tighter spreads, better liquidity in those contracts. So it will be a little bit easier to trade those contracts, even though they're pretty far out of the money. But for the most part, right, I'm never going that far out of the money. So this is a little bit of an exception, also given this particular setup that is really, really good. So let's walk you through. I'm going to pause the video and walk you through what I'm looking at here and why I really love this setup. So first of all, we notice that Amazon has a big gap up on the day. This video was recorded a long time ago, so unfortunately I don't remember if there was news related or if it was just the whole market was gapping up. But there was a big gap up on the day, and we see that Amazon was very strong right off the open. It has small little dip, and then it just ripped straight up into resistance. Now, what resistance did it run up into? Let's take a look up over here on our 5-minute chart. It's a little bit easier to see. This fuchsia horizontal line is marking the 9 EMA on our daily time frame, and the yellow horizontal line here is marking the 5 EMA on our daily time frame. Now, as I said, those moving averages are very well respected short-term indicators, and we know that obviously Amazon is a very bullish stock. The macro trend is bullish, is higher, but it recently had a little bit of a pullback. And so on the daily time frame, Amazon pulled back and sold off below those short-term moving averages, the 9 and the 5 EMA. It has now traded back up into them. So what I'm looking for is a breakout back above those moving averages for continuation of that macro bullish trend. So you have a very strong stock gapping up on the day into those very key moving averages on the daily time frame. We do have the prior day's high sitting just overhead, but that's not really of concern to me right now, because I know that given the macro context here that Amazon is poised to really have a significant breakout move higher, which, yesterday's high of day should be no problem for it to bust right through. So essentially, I'm looking for Amazon to have a nice strong move today, most likely going to have a much higher close today than yesterday. So yesterday's high of day really is not that big of a deal since it's just sitting overhead. The stock is looking really good. So it pushed up after the gap up. It pushed up into those moving averages on the daily time frame, and you can see that it pulled back, right? But look at how it pulled back very hesitantly, right? Just kind of chopping down lower. It actually came into almost a double bottom, a little bit lower. It held though. It found support. It found a bid. And then here is kind of the nuances of price action and things that you really need to pay attention to that can give you a lot of conviction in your trade idea, right? So we see that this huge monster green candle rips all the way from the lows back up to almost high of day, right up into those moving averages there on the daily time frame. Okay, so that really kind of nuanced price action right there is giving you a lot of subtle clues that's telling you, hey, this stock is clearly finding a lot of buyers. It is really poised to have a breakout move higher. It basically established a nice opening range as well. So you're essentially looking for an opening range breakout here. And when you get a stock that puts in your initial morning high and then it gives you a lower high, it gives you a perfect place to attach a descending trend line, which creates the flag, right? So you have the range established. It came back up, put in a lower high, and look how it's trading in this tight consolidation pattern right here. This is very, very key for breakout trades, right? You want to see that any move lower is just, it's very hesitant. It finds strong buyers. It consolidates, right? And so by consolidating right here, basically it's telling you that there is not a lot of selling interest in the stock. It's holding up over the VWAP, and the buyers are really just getting poised to see a big move higher. And that's what we're looking to, to play off of here. So this is the flag breakout. This is an intraday example, right? But with clear macro context from our daily time frame via those moving averages that we just discussed. So obviously the trigger for a trade like this is a break of that trend line. Okay. And now, although, like I said, we do have the prior day's high just overhead, it's literally just right there. I'm not overly concerned about it because of the macro context. I'm expecting that we should not have a big, we should not have a problem going much higher than that. Now the stock ends up going much higher than I really expected. Unfortunately, we'll see that. But what I'm looking for here is a clear trigger of a break of that trend, and we have to see increasing volume. That's very, very important. You have to see increasing volume. Ideally, your volume bars across the bottom of the chart here will start, sloping upwards, indicating that you're seeing more volume coming in on the breakout, and that's going to give you conviction that you're going to have the kind of follow through that you're looking for in the trade. Now, those volume bars, of course, they are lagging. It is a lagging indicator. Our best real-time indicator is going to be the time and sales for the underlying. Now, Amazon being a less liquid asset, the price action is a little bit trickier to read. The time and sales moves a lot slower than something like a cheaper stock like Apple, even SPY. The time and sales really races really, really quickly. These less liquid stocks, it won't be as obvious, but we're going to see these subtle clues play out. So let me go ahead and unpause the video. You'll notice that I'm watching this very closely right here. You see that the 3,100 calls on the ask is trading about 46.5. So if I were to hit this button right here to buy one contract, it would buy at that current ask price. And that's basically what I should be doing. The mistake that I make is that I hesitate just a little bit, and then on top of that, I hit the bid button instead. So that places my order over here on the bid, which I try to do on these more expensive contracts sometimes because you'll get a better fill given the spread and the price of the contracts. But in this case, because it was already triggering and breaking out, I should have hit this button instead. So you'll see that I was a little bit slow there, and I hit the wrong button. So basically I had to pay a much higher price for those contracts. Once I realized my mistake, I did click on the proper button and then I canceled the other order. So let me just back this up a little bit for you because it does happen a little bit fast. So let's go back so we can see the trigger play out here. All right, so here we are. If I'm looking at this with options, you do kind of, when you're playing breakouts, especially with options, you do kind of want to anticipate a little bit. Now, ideally in trading, you shouldn't anticipate. You should wait for it to trigger, wait for the stock to clearly signal the breakout is happening. Then you would get in. And when you're trading the stock, you're trading shares on a stock, it's much easier to do because you don't have all of the extrinsic factors of options, for example, that can really get inflated by the time the breakout triggers. So what I want you to pay attention to here is look at the price of the premiums. We're looking at the ask because that's the price that I'd be paying if I hit the button to get in right now. So look at the ask basically and what I'd have to pay right now. Okay, as it's triggering right there, that was the trigger. As that flash of green came through, we're popping up over the flag. You can see the volume increasing here, right? And although it's a little subtle here on the time and sales for the underlying, because Amazon is a little bit of a less liquid asset, the signal was there and I was a little bit late. And so look at the difference in what I'm paying and what I could have paid if I had hit the right button. So here we go. Once again, we're seeing it. We're looking, we're watching. It's testing the flag. It's testing the flag. I'm watching the time and sales here for any kind of a sign of a flash of green speeding up. You see it starting to come through here and we're popping over the flag. Premiums are 47.5 right there. Flash of green. I should hit it right there. 48. So I should have got filled at 48. If I had hit the button, if I'd hit this button, I would have got filled at 48. And now look what I'm having to pay. I just had to pay $49.50 to get in. So $1.50 more on the premium than if I had hit the right button and hadn't hesitated just that slight little bit. So that's a good example of why it's better to anticipate just a little bit, but it is a little bit tricky because you have to have that conviction to anticipate, right? You have to have that strong macro context in this clear case of a great setup here to really anticipate. So right here, I really should have been anticipating as it's popping over the flag. I realistically say getting in at 47, right? So let's say, because we're right at about 47 here, if I'd hit the ask right now, anticipating 47.5 maybe. So instantly up 2 points, just boom, like that right there. Look, 49 already coming through here on the time and sales, and there I am, 49.5. So if I had anticipated just a little bit right there at 47.5 entry on the premiums, look at that, already $50 coming through. So look at the difference, right? I'm barely up $100. if I had anticipated that move just a little bit, that's the key, just a little bit, it made the difference between being up $100 right now or being up $350. So huge difference. Now, Amazon made that quick push right up into the prior day's high. As I said, wasn't really concerned about that being significant resistance. It's right at the start of the breakout, not a big deal. We pushed right through it, right? So as we're in the money now on this one contract, not the best entry, definitely hesitated a little bit there, but we saw the clear signal on the tape coming through. It's a little bit trickier, like I said, on the low liquidity stocks, but we did see that signal coming through. Sometimes it's easier to see the option contracts here because more people might be trading these. So pay attention to both, right? Now, little flash of red coming through here, not uncommon, right? Because we just had two 1 minute candles headed straight up here. So some profit taking going on in this initial breakout move. I'm looking for a little bit more. I'm throwing kind of a Hail Mary order out way above the market, 59.60, because sometimes if volatility comes in and it spikes up real quick, sometimes you get lucky and it fills that order. So that's really what that's about. But basically, I'm still riding this out a little bit more here. It looks good. I'm looking for at least, a few candles up here. This initial breakout move. This is what I'm looking for. So I'm watching the price action. We got a nice, another flash of green coming through here with people hitting the ask. We're seeing the price rising here on Amazon as a result. Look at the price on the premiums, already up $54 coming through there on the time and sales. All right, so as we're pushing up right here, I should be getting ready to sell pretty soon because we are starting to get just a little bit extended on that 1 minute time frame. All right, so I still have my order sitting out in the market, but right now I'm beginning to realize that probably not going to hit a premium of 59.60 before we have some type of a pullback. And if you don't sell before that pullback happens, then you're going to risk giving up a lot of gains. So look at this great example. Look at the P&L. Okay, we're up 630 and we're fixing the top just over 700. And then I'm just a little bit, this is the second mistake that I made. I was a little bit late putting my order out. And I put my order out at 57.50 and I'm currently up. Let me pause it real quick. Currently up about $700. I put an order out at 57.50. You can see the premiums are currently trading around $1 less than that, about 56.5. So I made the mistake here of getting a little bit too greedy and putting my order out just a little bit too high when I can clearly see that the momentum is starting to slow a little bit. And, this is a decent size move. So it kind of makes sense that Amazon should kind of pull back a little bit here, maybe come back down and test that prior high of day. And then it could possibly continue higher. Now, here's the problem. I only have one contract. Okay, so if I had at least two contracts, then ideally, yes, I should definitely sell right here. I should sell as it's making this move up. I should have already sold one contract and locked in a nice little gain right there, and then held the second contract, the final contract, through this pullback with a stop at break even. If it holds here and rounds back up, then I'm sitting pretty and looking to basically catch another leg higher. But when you only have one contract, you basically just have to take that first move. Okay, you can't really hold for an even bigger move because you might not get it, right? So what happens if it pulls back here? Now look, I'm up almost $700. I think I saw almost $720 on one contract. Now look what happens. Watch how fast this P&L just vanishes on even just the slightest pullback here. All right, so just hesitating that little bit on taking profit. I could have gotten out at 56 if I hit the bid, right? But I didn't. And look, now it's starting to pull back and I'm starting to realize it now. Now I throw an order out at 56.50, a day late and $1 short. Now look at how much of the premium I'm losing here. I was up over 700 at one point. Okay. And now as it pulls back, you're going to see it dips down to like 300 or something like that. Yeah, look, 340. I just gave up half of the gains, over half of the gain that I was up if I had just taken it on that move right here. If I had just taken that last push right there. So that's how quickly It dropped under 300 there on the P&L. That's how quickly you can give up your gains and options if you do not take those moves in your favor. And that's why I always talk about selling into that volatility, selling into those moves in your favor, because the premiums are spiking on that move in your favor. But the second that they start to pull back, the premiums just evaporate quick. Okay, so it's that's the thing about options. Again, I talked about anticipating this breakout a little bit to try to get a better price. For me personally, it just makes me a little bit more comfortable because I'm getting a better price. I know that if the breakout does fail, I'm going to take a loss, but I got a pretty decent price, so the loss is going to be manageable, versus by the time I did get in, it was way up here. So if this rolled over and came down, the loss is going to be a lot bigger because the premiums are just going to melt really quickly after that spike up on the extrinsic value there. Without that follow through, that extrinsic value is just going to fall right back out of those contracts. Because remember, we are trading contracts that are really far out of the money. So they're juiced up on extrinsic value only. And so the second that Amazon even hints that it's not going to continue, that the breakout's going to fail, those contracts will fall apart. So what I did here is obviously we got this quick pull, and I'm looking on this retracement, and I'm looking to just get out. There it is. I just got out right there, locking in $595 on the one contract. So I could have gotten a better exit with the spreads and everything. How much better, I don't know, but still a good trade. But then the stock continues like much higher on the day. And this is the part of trading that can be difficult sometimes, guys, because when you see a stock that goes way higher than you anticipated, goes way beyond basically your trade plan, it can be, especially early in your trading career, it can be a little frustrating. And I'm taking a screenshot because I'm all happy with that trade. And then I'm fixing to watch these contracts just explode in value, but we'll let it run here for a minute so you can kind of see this. But it can be frustrating when you see how much money you leave on the table sometimes. But again, for me, this was the trade. Okay, this is what I was looking for. I wasn't necessarily looking for an even bigger move. Now, I knew that the possibility was there, and ideally, if I had more than one contract, I would still be in this, right? This is the way I would have played it. If I had bought two contracts, I should have sold one here, which basically I was a little bit late, but I was able to do after the pull back up here. So just in case this failed, at least selling one here, in case that turns out to be the high of day and it fails, at least I locked in some profit on the one, and I can set a stop at break even on that second contract. Otherwise, since we did hold and we broke high of day and we look good to continue higher, now I'm sitting pretty with that one contract, and I've already paid myself on the first one. So I've got a nice little win on the day. Now I can leave this one contract on to really see if we can get a home run trade out of this, kind of like a lotto contract. Sometimes it happens, and those times can end up being a really big winner. Now, usually it's just not my style because I am a scalper. I much prefer to catch this high probability move, right? The odds of another big move happening after that one get less and less the further the stock goes, right? It's not that it can't, right? This is really just the start of a move. So this is the first pullback here. So there's still a good chance it will continue higher, but we don't know that it will. So you have to always pay yourself, guys. You have to always pay yourself. And if you don't have any more contracts to run with, then unfortunately you just have to take this, right? But that's how I would play it. If I had more than one contract, pay yourself on that first move and then leave some on for the possible second move. But again, it's just not usually my style. I'm a scalper. I pretty much just like to hit this and call it, right? That's just my personality. I like to be in the trades for less time than really holding something for a long time. But absolutely nothing wrong with that. You can see that it is continuing to push up higher here. I sold that one contract at $55.45. I bought it at $49.50, so it cost $4,950 for me to buy that one contract, and I sold it at $55.45. Take a look at the premiums right now, $65. So there was a lot more. There was a lot more on the table. Now we see that Amazon is pushing up here into R2 resistance from the pivot point study. So for me, even if I was still holding that contract, I know for certain I wouldn't have held it past this. So that, I mean, that R2 level, the S2 level, that basically that second level from the pivot point study is always a potential reversal point. So for me, I wouldn't have held it past that. But I mean, look at that. The premiums are $66, $67 from $49.50 entry. So there was a lot of money that I left on the table there. And sometimes that can, like I said, can be really frustrating. But all in all, it was a really good trade, even though I only caught a piece of the ultimate move that the stock put in. It had solid foundation, good macro context. And this video, this live trading video, really kind of demonstrated perfectly the type of flag breakout on an intraday basis that you're basically looking for. It's not just any random flag. It's really important that also the stock is above VWAP, as we mentioned in the beginning part of the course, or the beginning part of this part of the video course here. It's really important on these flag breakouts to the upside like that the stock is above VWAP. I find that if the stock is trading below VWAP and you have a flag setting up like that a lot of times the flag will fail more often than it will work. So that's also something very important to consider. And again, look at the volume. Look how much higher the volume is right here since the breakout triggered, right? There's your breakout trigger. Look at the huge increase in volume, and you're continuing to see nice volume coming through as the breakout continues even higher. So that's why I talk about anytime you're taking any kind of breakout trade, volume is key. That is really the secret sauce. That is what you're looking for. That gives you that confirmation of the momentum. And as we see Amazon pushing up here, look at the price of these contracts now, over $70 from where I bought it, $49.50. Oh. But that's trading, right? I mean, that's how it goes. I mean, you're never going to catch the entire move. So you just forget about it, right? Be happy with the trades that you take, have your plans, trade your plans, and, be happy with the gains that you get. There's absolutely nothing wrong with walking away with, almost $600 on the day. I'm perfectly happy with that. So really good example here of a flag breakout for you guys. All right, guys, so that wraps up the course. I know it was a lot of information to cover, so go ahead and watch it as many times as you need to, and be sure and let me know in the comments below what you thought, or if you have any questions about anything that we covered. As always, guys, I really do appreciate you watching. Be sure you hit that like button, show your support for the channel, and I will see you guys very soon.